Have you ever wondered how ordinary people get the chance to invest in companies like Apple, Google, Tesla, or Facebook before they become even bigger? The answer is simple. At some point, these companies decided to sell a part of their business to the public. This process is called an IPO, or initial public offering. But here's the interesting part. Not every IPO makes investors rich. Some IPOs double in value on the very first day, while others lose more than half their value within months. So how do IPOs actually work? Why do companies launch them? How do investors apply? And most importantly, should you invest in every IPO? Let's understand everything in simple language. What is an IPO? IPO stands for Initial Public Offering. Let's break that down. Imagine you own a successful bakery. For years, you've built your business using your own money and perhaps some bank loans. Now your bakery has become popular. You want to open stores across the country, but expansion requires a lot of money. Instead of taking another loan, you decide to invite the public to become part owners of your company. You divide your company into millions of small pieces called shares. Then you sell those shares to investors. The first time a private company offers its shares to the public, that is called an IPO. After the IPO, the company becomes a public company and its shares start trading on the stock exchange. Why do companies launch an IPO? Companies go public for several important reasons. The biggest reason is to raise money. That money can be used to expand the business, build new factories, launch new products, enter international markets, develop new technology, or reduce existing debt. Another reason is credibility. Public companies are generally seen as more trustworthy because they must follow strict financial reporting rules. An IPO also gives early investors and company founders a chance to sell some of their shares. Many employees receive stock options. Once the company becomes public, these shares become easier to buy and sell. So an IPO benefits the company, its founders, employees, and investors. How does an IPO work? Let's understand the IPO process step by step. Step 1, the company decides it wants to go public. Step 2, it hires investment banks. These banks help determine how much the company is worth. They also help decide how many shares will be sold. Step 3, the company prepares detailed financial reports. These reports explain the company's business, revenue, profits, risks, debt, future plans, and many other important details. This information helps investors make informed decisions. Step 4, the company announces an IPO price range. For example, one share might be offered between $20 and $25. Step 5, investors apply during the IPO period. If demand is very high, not everyone receives all the shares they requested. This is called allotment. Step 6, once the IPO closes, the company's shares begin trading on the stock exchange. From that moment, share prices move based on demand and supply. Primary market versus secondary market. This is one concept every investor should understand. During the IPO, you are buying shares directly from the company. This is called the primary market. After the company gets listed on the stock exchange, investors start buying and selling shares among themselves. This is called the secondary market. The company receives money only during the IPO. Later trading happens between investors. How do people make money from IPOs? There are generally two ways investors try to profit. The first is listing gains. Suppose an IPO offers shares at $50. On listing day, if the market price jumps to $70, an investor who sells immediately earns a profit. The second method is long-term investing. Many successful companies have rewarded investors for years after their IPO. If the business continues growing, the share price may also grow over time. Long-term investors often focus on the company's future rather than the first day's excitement. Risks of IPO investing. Many beginners believe every IPO guarantees profits. That is simply not true. Some IPOs perform extremely well, others disappoint investors. Here are some common risks. The company may have little profit. Its valuation may already be too expensive. Market conditions may be weak, competition may increase, or the company's future growth may slow down. Remember, a popular IPO is not always a good investment. Always study the business before investing. How to evaluate an IPO? Before investing, ask yourself a few important questions. Does the company have a profitable business? Is its revenue growing consistently? What makes it different from competitors? Does it have manageable debt? What will the company do with the money raised? Who are the promoters? Are they trustworthy? Is the IPO price reasonable compared to similar companies? Reading the company's prospectus may seem difficult, but it contains valuable information that every serious investor should understand. Common myths about IPOs. Let's clear up some common misconceptions. Myth number 1. Every IPO doubles on listing day. False. Many IPOs actually fall below their issue price. Myth number 2. More media attention means a better investment. Not always. Popular companies can still become poor investments if they are overpriced. Myth number 3. IPO investing is risk-free. Absolutely not. Every investment carries risk. Good research is always more important than hype. Final takeaway. An IPO is simply the moment when a private company becomes available for public investment. It gives companies access to capital, and it gives investors an opportunity to participate in a company's future growth. But remember, an IPO is only the beginning of a company's journey. Successful investing isn't about buying every IPO. It's about understanding the business, evaluating the risks, and making informed decisions based on facts, not emotions. The best investors don't chase excitement. They invest with patience, knowledge, and discipline. If you found this video helpful, don't forget to like the video and subscribe for more easy-to-understand finance content. Let us know in the comments. Have you ever invested in an IPO, or are you planning to invest in one soon? Thanks for watching, and we'll see you in the next video. Disclaimer. This video is for educational purposes only and should not be considered financial or investment advice. Always conduct your own research or consult a qualified financial advisor before making any investment decisions.